My name is Patrick J. McGinnis, and I coined the term FOMO. That's short for fear of missing out, and it's why some people end up following the crowd. But we're not like them. We're part of a new species that isn't afraid to do things differently. I call us FOMO Sapiens. And this is the show where you'll meet people like us, phenomenal FOMO Sapiens, to learn how they find the courage and the ideas to live exceptional lives. FOMO. FOMO. Welcome back to FOMO Sapiens, the show for people who don't just follow the crowd, but instead take their own path to success in business and in life. As always, I'm your host, Patrick J. McGinnis, venture capitalist by day, author and podcaster by night, and FOMO Sapiens 24/7. And today, we're going to talk about billion-dollar companies, unicorns, and who are the people that build them and what makes them different with my guest, Ali Tamaseb, who is the author of a new book called Super Founders. Now, Ali is a partner at DCVC, a highly reputable VC firm with over $2 billion under management. He has invested in tons of companies, both in the US and globally, and his work has been featured in the BBC, The Guardian, Forbes, The Telegraph, TechCrunch, and Wired. And in our conversation, you're going to learn a bunch of stuff. For example, we're going to look at the data. So this book is all based on data and research that Ali has put together. And we're going to understand what separates the billion-dollar ideas from all the rest of the ideas. And it's based on this is insane 35,000 data points that Ali collected over 4 years. So he gets in deep. He also will debunk myths like the fact that, there's a certain age, whether you're 25 or 45, I've heard both, that makes you more likely to be successful. Guess what? I'm going to give you a little spoiler alert. There is no correlation, according to Ali. And you're also going to have data that's going to help you think about maybe you want to start a business, or you know somebody else who wants to start a business. Things like whether passion matters, whether you need to have a co-founder, whether you have to be an expert in an industry. And Ali's going to give us his advice on how to make the best pitch possible. Now, for my small ask today, it's a little tiny one, but it means a lot to me. Please consider subscribing to FOMO Sapiens and rating the show on your favorite podcasting app. I promise you, I don't ask it because it does nothing. It actually helps people to discover the show and grow our audience, and then I can just do more and cooler things for you. And now, onto the interview. Now, as you know, I always start my interviews by asking the same question, but once in a while, you like to mix it up a little tiny bit. And so I decided to start the conversation with something that's been on my mind when I think about the world of technology and venture capital. And that is that things are a little cray out there. And so I asked Ali to get started whether or not he thinks we're in a bubble.
That's a good question. I think that's, you go and read some articles from back in 93. I think I was reading that. And people have been saying there is a bubble in Valley in tech since a very, very long time ago. I think I even read something from 1980 something about home prices in Silicon Valley or the general tech bubble. And now it's kind of broad in the market. It's definitely true. Everybody is very optimistic, and there might be, the market may be stale for a while, and it might be a bubble, but I'm very, optimistic about this general trend, the ability of, technology to affect, much larger problems in the world and opening up much larger markets. So I think the market is becoming larger and larger, and these companies do have larger market share and market caps, but we might temporarily be in a very, very optimistic side of the market.
All right, I'm gonna ask the question slightly differently, okay? Because I agree, and I lived through the bubble of 2000, 2001, right? So I've seen it on the other side. So I agree, though, that technology is expanding. That these companies, it's not like in the old days where it was like these companies didn't even have a way to make money. A lot of these companies are making money or have business models, but I guess I would say, are the valuations disconnected from reality?
They are to an extent. They are to the extent that they are expecting a very, very rosy future, and they are expecting a very optimistic future. So they are in that term. But the fact that, I would say that the tech industry has grown so fast and so big, or some of these companies have grown so fast, so big, I don't think that's a bubble. And the fact that there's so many new companies, new venture capital firms, new startups, I don't think that's a bubble. But you see it with all the SPACs that are happening now, and a lot of companies that are going public that should not be public or are not ready to become public. I think there are elements of a bubble there, and bad things may happen to some extent of these. But I think on the general, just the fact that there's a lot more companies today, and there's a lot bigger companies today, that on its own isn't a sign of a bubble. But there are a lot of low quality companies going public, and there are a lot of low quality companies getting funding. That's a sign of a bubble.
Yeah. I'm thinking about WeWork right now. Not to pick on you, WeWork, but going public, I don't know about that. Anyway, so Ali, we're going to talk about your new book, Super Founders. And just to start out, you did a ton of research. So what really drew my attention to your book is the fact this isn't just somebody who's sort of just like writing their opinions on a page. You did the work. So why don't you tell us about some of the research that went into writing this book?
For sure. So I started working on this project over 4 years ago, back in 2016, 2017. And the origin of that is, I see about 1,000 companies per year who come and pitch. And I've seen some of them become massive successes. I am on the board of some of them. And I've seen a lot of them, fail. And a lot of people in the startup ecosystem talk about what leads to success and what does not. And they talk about you need to be technical. This is the number of co-founders you need to have. You need to start a new market. There shouldn't be any competition. There's a lot of things people talk about, and it comes from their personal experiences or a couple anecdotes they've seen, or to be honest, what they feel makes sense. Anyways, I come from an academic background, so when I hear these people talk about these, I just want to scream. I do not know how these people feel so confidently and talk so confidently about some of these claims without having any data backing them. So I wanted to see what is it that actually differentiates billion-dollar companies, billion-dollar startups from the rest on day one, without looking at their growth perspectives or what their week over or months over growth looked like. Just the fundamentals. What does this idea look like on day one? What the competition, what the team looked like on day one? And if there was anything that separated them. And there's no data on this. There's websites that will tell you how much money some of these companies raised, but that's it. So it took me 4 years to collect 30,000 data points, 65 data elements per company, anywhere from who the founders were, their career paths, what they studied, where they worked at, what was their title, where the idea come from, how the competition looked like, what the market looked like, what was the defensibility, what was the patent situation, what was the IP situation, what was the branding look like on day one, and fundraising, how often they fundraise, how frequent they fundraise, who they fundraise from, was it easy, was it hard. I quantified all these things for these all the unicorns founded in the past 15 years. And to have something to compare with, I randomly selected a large selection of companies that did not become billion-dollar companies, a randomly selected group, and collected the same data on them. That took me an extra 2 years. And then I had 30,000 data points I could compare and contrast all these things. And when I looked at the data, it turns out a lot of these things that people say about what leads to success and what does not are statistically wrong. Like, they're not supported by data. Data sometimes says the exact opposite, but most often it tells you this thing does not impact success. But also showed a bunch of things that do, and that's kind of where the recommendations in the book come. And what are the things that you need to pay attention to, and could lead to your success or a higher probability of success.
FOMO. All right, we're going to get into those today. Let's start with some of the myths, because I like this. What I like about the entire concept of this book, and especially because I wrote a book about part-time entrepreneurship, and a lot of people would say to me, you can't be successful if you start on the side. And I found the data that showed it could. So when you look at data, shockingly, I mean, this shouldn't be a shock, but sometimes we forget, you might find out that the conventional wisdom is wrong. So let's start out with one of the ones that you hit on and explain this to us and give us an example about the age myth.
Yeah. So I think this is one that is cyclical. I think when I read back, it seems like in the 90s or early 2000s, people paid attention to you need to be senior, you need to be you need to have a gray hair. And there was a lot of focus on older people are more successful in building companies. Then things like Y Combinator came on, and things changed. And now all of a sudden, everybody's looking into, let's go and source from universities. Let's go and look at people who have, interned at Google for the past 3 months, or let's go and invest in people who have been, who've been working at Google for the past 2 years. And all this is a bias towards, I want to invest in 20 something year olds, people in their early 20s. And it seems like at different times, or even at different industries or different parts of the country, there are different biases. Some people bias older people, some people bias younger people. Silicon Valley definitely goes toward the younger people. Some other places go toward the older people. There was this Harvard Business Review article that came out, I think 2-3 years ago, that says, the successful entrepreneurs are 45 years old. And when I looked at the data, basically the data looks at who got funded and who became successful. So it has a baseline and it looks at what succeeded. There is no correlation between age and success. The founders of these billion-dollar companies were anywhere from 18 years old to 68 years old. Yes, there is a larger number of founders who are 26 or 28 or 30 or 32 or 36, within that range. But that's the same distribution when you look at people who get funded and people who end up building billion-dollar companies. So when you compare these distributions, there's no difference. And people of different age can be successful in building billion-dollar companies.
What about failure? I'm curious, is there any correlation between failure and age?
Well, there's no, I did not look between failure and age, but when you look at failure and success, there is a correlation. What the correlation is, and that's actually one of the main points of the book, is the passion towards building. The data shows people who had a bug for building stuff, for selling stuff, for creating stuff, they were a lot more likely to end up and build a billion-dollar company. And by a lot, I mean about 350% more likely to start billion-dollar companies. And basically, the data shows if you have built and sold a company for $10 million or more, or something in that range, you are a lot more likely to build a billion-dollar company next. And if you've sold a company for $10 million, in the world of venture capital, it's a massive success on its own. And the founder may have made millions. But in the world of venture capital and in the world of mega billion acquisitions, it's almost looked like as a failure. No venture capital investor would get excited about a $10 million exit. It would definitely be looked at as a failure. But it's these people who are more likely to go on and build a billion-dollar company next. And it's that kind of, and that's why when you look at the age, you can be a 20-year-old who have built a bunch of stuff before, and it's your second or third company, and you may have failed before, or you may have started a small company before, and you may be 20, and you go and build a billion-dollar company. And I'm talking about Stripe, and I'm talking about Brex, and I've interviewed. The book has 15 interviews with these founders of billion-dollar companies, anywhere from Tony Fadell, founder of Nest, founder of Brex, to founder of GitHub, Zoom, Peter Thiel. A lot of these founders I interviewed, and each chapter comes with an interview. And when you look at it, age doesn't impact success, but your previous failure and successes does impact success. I talk about the founder of Calm, which is a meditation app, a $1 billion meditation app, and he built this website and basically put the logos of different companies on that web page for $1 a logo, and he got $1 million through that super simple idea. Anybody could have done it, and he did it when he was a kid. And it's those kind of characteristics of let me build something and sell online. Let me make some money online. And it doesn't have to be a $500 million company. It might be a small project, even a nonprofit, that makes you more likely to build a $1 billion company next.
So the age myth wasn't that shocking to me. When I read that, I was like, okay, I can see that. There are a couple other ones in here, though, where I was sort of like, because I've given people advice that was to the contrary. So I want to get into the next one, which is one where I was like, oops. I had literally told somebody like 2 days ago, that they should do this thing. And so I apologize. And that is the co-founder myth, because you write that you don't have to have a co-founder, and that solo founders weren't less likely to build billion-dollar companies, which is, to me, I always think like, oh man, if you're on your own, it's just like, ugh, it's easier to quit. You have less support. You don't have that person to bounce ideas off with. But you found in your study that is not necessarily the case. So talk about that co-founder myth.
Correct. So I think, again, exactly the advice you talk about. There are places, there are incubator programs, there's accelerator programs that wouldn't let you in if you're solo. They would encourage, you finding somebody, from somewhere and teaming it up. And obviously there's a lot of good things about having a co-founder or multiple co-founders. Everybody can bring something to the table, but there's also problems that can come out of, there are some companies that die just because of co-founder conflict, or that the founders didn't work, or somebody had a more dominant ego or did not. Anyways, when I looked at the data and compared the group of random companies that got venture funding and the group of billion-dollar companies, there was no increased or decreased chance for any number of co-founders, which means if you're a solo founder, you're as likely to succeed as if you're 2 founders, 3 founders, 4, 5, 6. Alibaba has 18 people with the co-founder title. And 1 out of every 5 unicorn founded in the past 15 years is solo founded, which is shockingly high for kind of people giving that advice that, you shouldn't start a company solo. When you look at and you kind of zoom into the data, you see something though. Those solo founders, they were more likely that this was their second or third company. So they may have started companies with other co-founders before. Those companies may have failed. Those companies may have succeeded. They know enough, they have enough connections that they can start this next company solo. And I'm not advising anyone to start a company solo. I'm advising people not to care about the norms that, I need to be 2 co-founders, or I need to be, this many co-founders. If gather the best team that, everybody brings something that you need to the table. And if that means you need 6 people, give all the 6 people a co-founder title. If it's just you and you've started, you don't have to somehow find another co-founder. Just go at it. Go start it.
FOMO. It's interesting what you said. That was very provocative. Talking about these rules. It's like, what is so funny is we expect entrepreneurs to be flexible and resilient and think outside the box and try things that haven't been tried before. Yeah, we also put these like very strict rules. You must have a co-founder. You must have a technical co-founder. You must have worked in the industry on them, which is just kind of weird to be trying to put all these boxes around people who we want to think outside of the box. So
exactly. It's an outliers game. You can't create outliers by putting them in a box or creating proxy rules.
So don't put entrepreneurs in a box. Now, the other one, this is like, now I sort of arrange these questions so that we get to like farther up the Patrick got it wrong meter. Cause I can own that. This is one. And funny enough, we did an earlier show with Jim McKelvey, the founder of Square. And we were talking about this, and he also agrees with you. So you guys, you're in good company because he is a very amazing man. And it's the expertise myth. When I talk to entrepreneurs, I'll say like, well, did you work in this industry? And if not, like, why are you here? And what you found is you can disrupt an industry without having necessarily sort of worked in that industry before, with the exception of the hard sciences and life sciences. You make that clear exception. And you can do that as long as you acquire the right soft skills and connections. So I'm still not convinced, even if Jim says it. And by the way, whatever Jim says, I believe. But still, Ali, can you please, I don't know, just tell me why that is true and try to convince me, because I'm still not there.
Well, I mean, first thing, the data tells you. In data we trust, right? So when you look at the data.
By the way, I just want to interrupt you. That is the best answer I've ever had on this entire podcast. You just smacked me down, and I like that. I respect that. So okay, data, go there.
I mean, look, it's not just you. Like, even when I look at my own previous Medium articles that I've written, and when I look at the previous things I have told entrepreneurs as advice, I find that I've given a lot of wrong advice. I've given a lot of personal anecdotes that are not supported by data. And I think that's the reason I pushed on, writing this book. And, it's a labor of love, but I hope this can push our industry ahead to, forget these rules and let people build. Let people build big problems. We have so many problems in the world, and we need the entrepreneurs to go at it and solve them without, creating these proxy rules or who gets funding or not. So the data tells you, I think it's 70% of founders of billion-dollar companies in tech, um, specifically in consumer and SaaS side of things, did not come from that industry. It doesn't mean they did not have industry experience. They had 11 years of work experience on average, but didn't have to come from that same industry. Now, it doesn't mean if you are from the industry, you're less likely to build a billion-dollar company in that industry. It just says, when you look at the data, it does not make a huge impact, or it doesn't even make any impact on your ability to create a billion-dollar company. What does is these soft skills. You create these connections, you create these resources, and you create these, skills for management on how to raise money. You'll learn these stuff, and learning something specific about fintech or a regulation or something about insurance or whatever industry you're going after, if you have learned the right skills for learning fast, finding the right resources, networking, using your network, managing people, raising money, then you can go from industry to industry. And sometimes it's better, sometimes it's not. And I think that the biggest example that I have here is founders of Flatiron Health that I interviewed in the book. And they've created a bunch of companies in a bunch of different industries. They started with something that looked like an Instacart as their first kind of company in college. But the one that worked out was an ad tech company. They created like an advertising technology company that Google acquired for $25 million, if I'm not wrong. And then they started a company in the healthcare industry. Flatiron Health, that's a real world evidence, data for oncology for cancer, and which was a $2 billion acquisition. So what they learned from that first business was, how to raise money, how to create a board, how to hire, how to manage people. And they used those connections and resources to go and learn whatever they could about cancer, whatever they could about healthcare IT, and whatever they could about these people, and hired the right people and created the right company. So learning specific things about the industry you're going after, that's not easy, but that's easier than learning these kind of soft skills for how to manage people, how to find connections, and building that kind of Rolodex and those resources that you need to create a successful company.
I think when we think about entrepreneurship, the way that it's portrayed in culture and business culture, it's like there are these superhuman people who do these things that are truly impossible. And what we forget is, and by the way, I've always thought that, and I have good friends who are entrepreneurs. It's like, oh my God, how do they do this thing? But what we forget is like, it's a job. You learn how to do something. There's a pattern recognition bit. You've messed up before. You learn how to fix it. And like anything in life, whether it's cooking a cake to, training for a marathon to giving advice to people, it's like you learn as you go along and you become more competent. And then as you do, you can expand into areas where maybe you weren't operating before. So that all makes a lot of sense now that you've explained it. And I will give different advice in the future. So now that we've corrected everybody's sort of misconceptions and all the things that I had wrong, I'd love to just take a minute. We have people who are listening to the show who are entrepreneurs or who want to be entrepreneurs, and they're going to be pitching. Let's imagine they've got a business idea. They're working on that deck. They're going to meet a VC firm or an angel investor. What is your advice to entrepreneurs about pitching their company and having, thought through the elements of a business? What are the most important things to you?
So this is also another contrarian thing that I talk about in the book. The pitch doesn't matter. I have seen companies raise $5 million without a single slide deck, and they weren't even repeat entrepreneurs. And I've seen people struggle to raise $200,000 with the best pitch deck, with the most practiced, storyline, things that make perfect sense, the follow-up, the introduction, everything's perfect. They fail to raise. And what's different? Substance. If you're pitching to the right investors, they're smart. They're not. You may be successful in this first meeting if you have a super polished deck and you've thought about everything and you know the answer to everything. But in order for you to get money in the bank, your business actually needs to have substance. And that substance is team and is traction. So my advice is actually, I think that it's a quote from Paul Graham that says, entrepreneurs, when they try to pitch, it's like, trying to pull something in the wrong way and they hurt their back. And that's because instead of working on actually their business, they're working on the pitch for their business. So spend your time, close that extra customer. Like having that 50K more or 10K, whatever, that extra customer, that's going to go along a much longer way than, your deck that may have, a 5% better design or a 5% better story. So focus on that. And your deck, I think for you to succeed, you need to be thoughtful. So take that investment pitching process as a time for you to think very deeply about your business in the future, and how I am going to get distribution right, how I'm going to get hiring right. You need to have thought about your own business more than anyone have ever thought about that specific business, and for you to know more about that and know more people in that area than anyone else. If you're thoughtful about what you're doing and if you're resourceful in the area that you're going after, the investor, if you're pitching the right investors, they would understand and they will trust that and it doesn't matter if you have a 10-page slide deck or 5 or 20, or if it's a very well designed or mediocre, I think you will get funding.
All right, everybody, substance over flash. That's pretty good advice. The book is Super Founders. The website is superfoundersbook.com, where you can pick up the book, and it's basically available everywhere where books are sold, including Amazon, of course. Ali Tamaseb, thanks so much for being here. FOMO. If you like today's show, please be sure to rate it and recommend it to your friends. And as always, you can find me on Instagram at Patrick J. McGinnis, on Twitter at PJ McGinnis, and on the web at FOMOSapiens.com or PatrickMcGinnis.com, where you can get all kinds of free resources to live a more decisive and entrepreneurial life. FOMO Sapiens is recorded in New York City. Theme music is by Mike McGinnis, and editing and post-production is by Josh Elstro. If you like today's show, please be sure to rate it and recommend it to your friends. And as always, you can find me at FOMOSapiens.com and at PatrickMcGinnis.com. To advertise on FOMO Sapiens, reach out to contact@FOMOSapiens.com. FOMO.